35 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Tonight's video, we're going to continue the long-term outlook. We'll cover Treasuries. We'll also go through the Dow and the Fed. So let's get into tonight's video. Welcome, everyone. It is 8 p.m. Eastern Time, and we are back live. It was interesting. Last night, the stream didn't end. It was still going for 7 hours, so I've taken it offline. There weren't any good, interesting hot mic things or anything like that. I'm going to edit it down, so that video will be gone for just a little bit. After tonight's show, I'll edit it and repost it. Anyway, in yesterday's video, we dug into some of the longer term trends, all the way going out to the secular and 3-month trends, or the quarterly chart. And it was interesting because we continue, as I discussed last night, that the indexes are still in this sideways choppy range. One of my newsletters the last couple of days was actually called, buy the dip is still alive. That continues to be the strategy. It looks to me now that we are really set up to potentially break out and test that 6,000 level again. Last week we hit 6,008, I think was the exact high. There was probably a change on the futures. Now we're looking at, just for today's values, we could test 6,000, possibly go to 6,020 on the S&P. So not a lot from my viewpoint. Today was kind of a pivotal day. We did have, there was a trade that came out on the trade sheet. Unfortunately, I still haven't got this project done where I can get these sheets to you, and I'll show you the one that I ran tonight. But these things are, basically are doing real-time analysis and putting trades out. So the trades from the snapshot that I'm showing you on the show right now, compared to the one that I'll put into the Substack later tonight, is not completely different. The market grid numbers are the same, but some of the metrics change a little bit based on where the position of the market is. So my plan is with these sheets is to be able to get them so you can push a button and it just kind of refreshes with new data, and then you can get new trades. But there was a trade that came out around the London last night that was 59.25 sell. It was looking for 59 even. Put the trade on, and I took it out at around, I think it was 59.12 or something. It was about a 12-13 handle move, and it was pretty easy to capture. It did go down pretty close to the target. I think it fell just short of hitting 5,900. But these trades that come out on these sheets, make sure you monitor them. Like I said, ultimately, I'll get them where you could even rerun them on the U.S. Open the next day, and that will even be more valid. Probably have another early night with the newsletter. I think the newsletter came out at about 3 a.m. or so, 3:30 a.m. Eastern time. Typically, they're coming out at 5 to 6. So probably another early night. I've got some things that are getting me back into the U.S. markets earlier in the day. But from the standpoint, we still kind of are running in this void of everything right now. So what I want to accomplish the last couple of days, and we went through it yesterday, what I want to accomplish is to get us through and look at we're going to go through Treasuries, and we'll go through the Dow. We'll talk a little bit about the Fed once I get into that section. So tonight will probably be maybe a little shorter videos. I think some folks will really appreciate not being an hour long. I get it. it's like I said, it seems everything I do is long form because even the Substack is pretty detailed every night. So anyway, so let's go ahead and we'll go through the database. And last night I found out, thanks to Bo told me that the database hadn't updated, and the way that our environment works, as soon as our data vendor releases the file, then we run everything, and they didn't release it until we were done last night. So the stats I went through last night on that video were incorrect. They have run tonight. Looks like everything's good to go. So I apologize for that little misstep there. So let's go ahead and take a look at the database, and I'll get that set up here so we can dig into that. So as typical, this is just the daily database. We're at 65.78. It's been interesting, I'd have to say, in the last year and covering the database every day like I do. One of the things that we see happen here is a stabilization. So last year, the intermediate database stayed well at 61% was the low water mark, and it went from 61 to the low 70s several times back and forth. But we were in a basically looking at the S&P in about a 25% gain for the year. It was a little better, a little worse during the year, but we're seeing a similar thing happen right now where the short-term database is just kind of grinding around this 60 percentile range. And I'm just do round numbers here. We had 563 new buys on the dailies, and we had roughly 782 exits. So we had a slight negative rotation. One of the models was more bullish, one is negative. We've been actually going back and forth on that. And if you get the Substack, which it's just go ahead and do, the advertisement is it's kendallreport.substack.com. I'm really suggesting, by the way, all of you that see this, that get that, is use the Substack app. I actually really like the app. I think it's cleaner than the email, but whatever you need to do, you need to do. Nice thing is you can hit the play button. It will read the newsletter to you. So you can be lazy, or if you're driving in a car, you can get the information. But what we're seeing here on this database is just a continuation of this grinding in this sideways range. So we're seeing the database refresh. So what happens, it's a giant database, 14,639 symbols in the database. So we see this type of rotation. So right now, roughly 6 out of 10 symbols are long, but what happens is this rotation, we'll see this buy and selling going on, and there'll be times where it just kind of grinds, and that's what we're seeing right now. So one of the things I'm hoping to do in the future is not only be able to see these numbers, but to actually see what we're rotating in by sector or group or something like that. The new process that I'm working on right now will dig into the database, and it will also add some intelligence in the database as well. So it'll read and tell you what to expect on metrics and things of that sort. So building some probabilities, and with AI, we're able to run some math that normally would take a lot of programming, which we can now do by asking a simple prompt to get this information now. But the patterns that we're seeing here is just a continuation from the standpoint of what's been going on. If you recall, if we go back to coming in when we were printing the lows for the year, which in the case was 48.32 on the S&P, when we printed down there, the database was pretty much blown out. We had earlier in the year had exited a lot of positions. We got down to about 10% of the symbols that are in this database were long. So it was basically what we call full liquidation mode. And then we came out of that, we moved up to about 72%, back into high 50s, but then we're just maintaining now at the 60% level. And this is a pretty healthy sign. And we're seeing the markets just grind out. And like I was saying on the comments on the opening, the buy the dip trade is still working. Every time you see red, you can almost buy the red, and it turns green by the end of the session. And we've also been stuck in this range. I'll go through the details on the S&P here in just a minute. So we will cover the S&P and NASDAQ on a daily basis. Then I'll go into the long term and we'll also do some yield curve discussion as well tonight. But the bottom line is the database is just grinding here. We're on the intermediate database. If I spin out to there real quick, we're right now at 42% long. You'll see it come up here, 43.93. So that's above that minimum traction that I talk about all the time. That will get you to exactly what the what's going from the standpoint of the trend. So there's enough traction now that we're locked in the sideways trend. Probabilities of a new low from where we sit right now is not zero, but it's certainly very low. And so we're just grinding out, trying to get enough traction to figure this out. I am going to attempt to do something here mid-show. See if I can pull this off. Good, I will be able to. Bear with me 1 second. So one of the, I put this in the Substack every night, and I'll put this is the database I was talking about. It's going to give you messages on what's going on. This is the same information. It was just on the WaveTech. This is just kind of rebuilt, and I'm adding in some intelligence here on some things, and then ultimately you'll get this little message. It'll tell you about the traction database. A lot of the stuff that I talk about all the time on the database, I'm actually building in the intelligence for it to look. And so when I'm reviewing the database, you're going to get a review right off of this sheet when I finish this project. And it's going to actually have a number of areas, and potentially I'm going to put in like an executive summary on weekly updates and things of that sort. So basically I'm training it to look at the database, do the analysis. It knows where all the trigger points are. Right now this is a static, this isn't the interactive database, but it actually, all these trigger points that I talk about here is what's programmed in here. It'll actually tell you all the different, so you don't even have to think or do analysis. It will actually do virtually everything for you. So I'm looking forward when that data is around. So, but back to this, where we're at right now. Right now we have the 6 sectors long. We're starting to see some fade. Even though we're seeing this sideways movement, there's still metrics happening behind the scene that is giving not a bearish tone, but more of a consolidation tone. So let's go ahead and go through the S&P here. And this is a broken record story that I have, that I've been talking about. We go all the way back to here to May 13th. We've basically, with the exception of 3 sessions, we've been almost printing the same range every day. I was just saying before I came on, I hate how this market's trading right now. It's just, there's no trend. From a trader standpoint, it's good. I've had some good days trading, but as far as a trend, we've kind of just stalled here and flattening out, and we're still seeing the PPMs starting to get to the point where we're seeing a loss of momentum. So there's no breakout, even though we're sitting here at 6,000. The highs were what, 61, I think 61.60. Let me just see if I can get over there real quick. Yeah, it would have been in this range somewhere right here. Yeah, 61.62 roughly was the all-time high. And so we're just kind of, a buck and a half away from a new high. But I keep arguing if we do see something come out and we get some kind of pump and it goes into a new high, that I suspect it will be rejected there. And that pattern is pretty predominant. This is not necessarily a bullish or bearish pattern. It really is just set up more of that range. Now, I went into last night. The video's not available. I will fix it and repost it sometime in the next 6-7 hours, and I'll get it up there. Right now, it's a 7-hour long video with a blank screen for 6 hours. So I'm going to clean that up and put it back up there. But one of the things I discussed in last night's video is that we're really seeing these big wide band trade ranges set up on the monthly charts, and those are going to be dominant possibly until year end. And while we probably don't see it, we probably have established the low of the year for right now, but we may not have established the year high, but I don't see an emerging trend coming out at the moment. And it does look to me that we're still going to have a really choppy Q3 and 4. So we're final month of Q2 right now. So once we finish June, and we'll move on to Q3. And I just don't see the super positive tones on anything that's going to drive the market higher. Now, we could get all the trade deals happen. China's happy. Maybe that would be the case. My biggest concern right now is this little global risk that we have coming in with the Ukraine going and bombing a bunch of Russian bombers. I have to give them pretty brilliant what they did to pull it off. But, I'm just really concerned about us getting sucked into World War III. And, I've actually never, other than a few scrimmages, none of us have ever been around during a war market. I mean, like a real war like World War II and all the elements that happened back in the, from the crash of 29 to leading into World War II and then coming out of that into the great industrial age. This is all textbook stuff. I was born in 1952, so I was around but was not aware, as they would say. But the point is that I'm hoping that we don't have to find out what that looks like. That would be very bad. Right on the, we just need to get our act, stop spending money and get rid of taxes and a whole bunch of other stuff, and we'll all be a lot better off. So let's go ahead and cover the NASDAQ real quick. It's going to be a similar type configuration here. NASDAQ has a little higher. I've been doing in the Substack, every night I've been kind of doing a comparative analysis so you can contrast what the S&P momentum or lack of, or how the indicators are positioned against each other from the S&P to the NASDAQ. And NASDAQ, as usual, has even a stronger tone or a weaker tone. It tends to be the leader, and it has been that way for a lot of years. So the patterns that we're seeing here are a little stronger. One of the things I noticed, and when I was looking at the charts just before we went live, is one of the things that we're seeing is you can see the red dot up here. Let me just focus in on this. They're focusing like straight down into these moving averages. We're also seeing, this is a daily chart. Same thing was on the S&P, just covered here. This little configuration where all these moving averages are, I think we were ultimately going to probably trade back in. This is 20,800 range, but I think we probably flatten out and start to roll. Maybe it gets at 21,001 to 20,900. That's probably where we're going to end up in this range. As I talked about, this is a daily. So if we close lower today, then we'll probably see the market grid turn down. We'll see everything start to flow in. So from the trades, let me bring up the PPMs here. just like with the S&P, we're seeing momentum loss. But even down here at the worst momentum loss, we're just barely negative. So there's still an underlying positive bid. So this is why I continue to tell you there's not going to be any big collapses from here. But we're coming into that convergence point where the 10 and 21 day moving averages are about to potentially cross over, and that could set us up where we get a retest of the 200. Same thing would happen on the S&P as well. Yeah, I got it, Bo. The sound was off. Okay, so I'll restart that. Apologize. So, yeah, so sorry about that. So, as we come into the Treasury market, what we're looking at is the potential for the markets just to stay stable. There's not any big signs of anything that's going to happen here from the standpoint of the trend. So we're not looking at interest rates to blow up, more stable. We have these upper ranges, that these Fibonacci targets, and just zooming back in on that. Apologize for the sound. 483, 510, 527 is the targets for that, and they're still live, but there's not any momentum. You can see the indicators here are just really flat. So we're not seeing any projection. Things can change. That 472 I've been talking about is still a valid number, but these upward fib targets are still very real and can be reached. So let's talk a couple minutes here. I'll just come back on screen. Let's set this up a little bit from the standpoint of what's going on with let's talk Fed for a minute. And I think the Fed is pretty irrelevant right now. They have no real purpose in life. As I've said before, I think Trump with his capital investments has way more power if he can make those real, to have more impact on the economy than anything the Fed's going to do. Fed doesn't see anything to do right now because basically inflation continues to be well under control in spite of every news agency, everybody telling you that inflation is going to come back and all these things are going to happen, and they're not. From the Fed's viewpoint, I think this meeting we're coming into in the next couple of weeks are the charts I'm just showing you, and I'm going to go back and we're going to look at the yield curve, is that we're really looking at a very stable market here from interest rate standpoint. There's no big demands coming. Housing's still under pressure, so that's not going to jack up the back end for demand or anything like that. However, if we get another round of selling, or there's tariff news or something that happens, and maybe we'll get some more selling. The selling that we did see was based on a bad 20-year auction, which I've talked about many times. Is that auction was considered to be basically a filler from the standpoint of the spectrum of the 20-year. The big primaries we know are 2, 5, 7, 10, and the 30. In between those, there are some maturities in between. The 20 falls in between that 10 and 30, and it's really just to fill certain types of gaps in the balance sheet that they're financing. Okay, so when that auction went bad a couple of weeks ago, everybody and their brother, like I said, that's traded for more than 2 years, that are now an expert, are telling you that the bond market's blowing up and the end of the world and the banking system's going to fail, and not so much. But there are plenty of risk and things for us to deal with. But the reality is that the Fed doesn't have much to do here. This next meeting is going to be another pass meeting, I believe, where everything's just going to stay like it is, and Powell will continue to use pretty much the same script. If you think about it, the Fed, we parse out a few words from their statement every meeting. And if you look at Powell's statements, maybe going back the last 5 or 6 meetings, they're pretty much the same. And so they're staying the course here, and there's nothing to be done. Nothing's showing up on the chart. So let's go back to the chart here so we can take a look at this. So this is the daily. Let's move out to the weekly, because we want to go to the longer term aspects of this market now. So we also have up on top here, we have on a weekly basis, we have 3 live Fibonacci targets on a weekly, which these get a little more scary in that we're looking at 509, 555, and 584. These are big numbers. You can see these green dots up here, and these green bars are where those forecasts are. So like I said, we're looking at 509, 555, 584. And these are live, but let's take a look. This is one of the things when we get these. So if you have the indicators, kendallreport.com/indicators24, if you want to check them out, that is, we want to look for confirmation. So we have the Fibonacci targets. Is the projections looking like it's going to get confirmed from the standpoint there's enough momentum here to suggest that we're going to see some movement in that direction. So we're not seeing that on this. There is a little bit of upward formation coming in here on the. If we look at this here, there is some upward flow potential. Is it going to be enough to get us up into this level? This first target here is, like I said, 511. 472, I mentioned this number for weeks now, that if we get above there, then there's definitely a lot of selling coming in. So we're going to go to the Dow next. So we'll see if we can see if the Dow is projecting some kind of surge downward that would suggest that we're seeing liquidation of treasuries. And I don't know if I brought this up before. I think I did, but I believe it's about 60 to 65% of all the treasuries that are, we always talk about how much the Chinese and, the Japanese and foreign entities own of the treasuries. Well, 65% of them are owned by American banks, entities, you and I, is American owned. So 65% of that interest that's being paid is coming back toward the U.S. economy. So there is an element there to worry about when you have somebody that's got, 10 or 12% stake in the treasuries. But this market is so gigantic, it's unlikely to be taken over by the bond vigilantes and coming in to crash the market out. And because you have to think about it, if the treasury market is, I would say the currencies are the number one market, biggest, and because they're basically encompass everything, and then you get the bond market is next. It's absolutely essential to everything. And so why would you want to crash the bond market if you wanted to live on the planet? You wouldn't. And you wouldn't want to see that happen. So the probabilities, I always say these big, giant things that people talk about, this is going to crush the whole system. That stuff doesn't happen because you always have to look at if something's going to crash, who benefits, who's going to benefit from starving people trying to eat each other? Nobody, right? So the probabilities of these big treasury collapses aren't very likely, but some of these moves are real. This is not a collapse, but it would be if we did go into the 5 handle and move up into some of these target numbers, that would be big. But what we're not seeing is the confirmation. So this is where I started. The confirmation on as far as the momentum indicators and everything telling you that yields are going to start to go through the moon. So we'll go one more level here, and we're going to go monthly. And monthly also has some pretty ugly fib targets. I'm going to really zoom out here because this was interesting. We went back to October of 23. I remember talking about these numbers when I did long-term review. If we come up here, at that time, we're looking at 710. Let me blow this up so you can see it. Yeah, 710, 869, 962, right? So those have been negated and then recalced. This is the new live, and we're at 535, 601, 643. And typically, if you look at the history of these numbers, you'll see here that if one of these fib targets are going to get hit, usually it's fib 1 on these longer term. And you can see over here, back in 2019, we did get up to this fib target, which was 332, and the high there was 326. So we came right up to that number, and that would suggest that's lower end on a monthly would be at this 534 number. And that would be a pretty disastrous number for sure, and that would suggest that we're going to see mass liquidation from there. So I'm going to bring up the yield curve chart real quick, and I've been on this thread that I'm about to present to you folks for a while, and it really is the formation of what I think the yield curve is going to do. So I'm going to bring up, I have a, hang on, I had this all, okay, good. It didn't mess it up. All right, so let me bring up this chart so you can see exactly what I'm talking about here. So this is the red line is what the yield curve looked like in January, the beginning of 2024. So this was the inverted yield curve that everybody was screaming about. And the blue line is where we are today. So, and if you recall, my prediction was that we would see that yields would come on the front end would come down to around 4.25, and the back end would be almost a flat yield curve. So you could argue that's sort of right. Let me just bring this in just a little bit so you can see it. So right now where I'm at here, the Fed funds upper target 425. Yeah, this thing's frozen here. There we go. Yeah, so we're looking at the upper target. This is where we are right now. This is the 4 and I think 440. So that would be around the 10-year notes right now. So we basically have a slight upward slope from 4.25 to 440 and a little bit of a flattening here. I believe that the Fed by year end will at least go down 25 to 50 basis points, get us down to 350, and the back end of the curve is going to stay pretty static around 4.25, could stay up here as high as the 4.5% range. So I just see the yield curve going into what we call a steepener, and that's the very healthy configuration if we can get there without any disasters coming off. And at this time, well, you will hear Bob Kendall talk about the Russell 2000 being in play. Until this yield curve changes, nothing's going to happen there. It's going to be a laggard. There's not going to be anything coming out of here, and there's no reason to predict it otherwise. A large percentage, I need to find out exactly so I can quote that number, but a large percentage of the Russell 2000 are regional and community banks and a lot of financial institutions and smaller institutions in there. And these guys need that yield curve structure to be able to actually move those companies forward. Also, a lot of the smaller companies have a fair amount of debt and they need this lower front end, and with the back end, they'll be able to borrow in the mid-range and kind of roll their debt and actually make things happen. And theoretically, the deals that Trump is bringing into the economy, which would be 26, 27, will also benefit those smaller companies because they will be most likely part of the supply chain that's going to have to be built from within. So that's the theory behind that. Right now, no play. A year and a half from now, someone will go, oh, Tom Lee was right. Well, if eventually you're right, that's right. But the fact is he's been wrong because there's nothing to drive these short, smaller stocks right now until this especially on that index is as a bunch of zombie companies. There's nothing. There's good companies in there, but the bulk is they all have this structural issue that's going on. So so that'll cover us on the yield curve. So let's go ahead and let's go back and let's move on to the Dow. I'm going to stay here with the monthly chart. So we'll go top down on the Dow, and Dow is pretty much at the lows that it's been for a while, and it looks like it's trying to recover on a monthly basis. We're looking at further declines, probably all the way into year end. Okay, and I continue to tell you folks that my expectation is that we're going to see softening in the economy in Q3, Q4, possibly all the way into 26. And I mentioned this last night that one of the things that could drive this is that they don't get the tax deal done, or there's a whole bunch of haggling or it's last minute. It's going to keep a lot of uncertainty in the economy from the standpoint of businesses that are trying to make decisions. And taxation is always one of the biggest things that have happened. It's interesting because if you flash back to the early 1980s when I started in the market, the rhetoric was that the government was going to suck up all the money. There wasn't going to be any money for investments. The reality is what happened is the tax cuts, the 81 Reform Act and some other things that happened just liquefied the system because of the lower taxes. And those higher yields were literally absorbed at that time. And then everything kind of restructured. And it took, we're talking about 84 to 86 was that. And there was another tax act, the Tax Reform Act of 86. We could do a whole show, maybe 3 shows, just talking about what happened then. But everything got restructured. And if you look back at, we'll call it 82, that was really the beginning of the big bull market into the 87 highs. But you could argue, and I did argue, that the high in 87 and that whole mess that happened after that coming into 89 and 90 was coming into the dot-com situation, which was a giant wave 4. And now then in hindsight, it became a wave 2, and then this monster move up. I remember in 1993, 94, telling some of the folks at the firm I was at that you're not going to believe what we're going to see going forward. And of course, we rallied all the way into 98, and there were issues going on there. So the results of just looking at if we zoom back to that period of time that I'm talking about, see if I can get this to work. Yeah, so this was what the U.S. dollar looked like, and this was with the high interest rates, and then the dollar came back in. Here's 81, 80. Here's the period I'm talking about. Dollar rallied. Started the rally in 95. This is where I remember at this time, I've been writing newsletters, analyst, and trader for a long time. And during this period of time, it was discounting the dollar, kind of kept if we overlaid the index over here, S&P or Dow Jones at the time was pretty popular, you would see that the markets did fairly good, even though rates were high, the dollar was low, and then they pumped the dollar up, and this got us all the way into kind of the dot-com burst right over here, then see where we are. So if we look at this perspective, if I zoom out, this is going back to 1967, where my cursor is here, all the way to current. We're really kind of coming up along this 200 line that's coming in here right now. So that would be, and I've talked about this for 95, 92. If we get down there, that's probably where the stability of the dollar comes in. We do have Fibonacci targets up here that are screaming 126. Don't think so. If we bring up the indicators, we'll see really just stable. Everything's pointing. If I zoom in here, everything's pointing for us to come into this kind of wedge. We're down in here right now that we just kind of flow in here with this 10-period moving average being the driver. So doesn't appear to be, there's plenty of range here, by the way. This is 90, let me just go to extreme, 94 all the way to 102, 103 is the range we're talking about. And that's probably where we end up to be range bound for a while here. So that looks like to me where the dollar is going to kind of land at that point. Just looking here, timing wise, we're 44 minutes in. So what I promised we would do Bitcoin, so we're going to segue into Bitcoin, and then we'll call it quits for tonight. Wednesday, we'll have some news coming out. Tomorrow's market with the ADP, some other metrics. Hopefully, we get the equity markets to actually trade a little more active. We're looking at up 2 handles right now. One of the things I did not show you, which before I go in and do Bitcoin from here, I'm going to bring this up, I hope. So this was the data sheet from the S&P. I know I'm a little bit out of sequence, but it went from yesterday being in consolidation back to 85% bullish, and we're looking at the ranges here. All the PPMs are back positive again. We had a negative PPM 1. Everything turned around with that little bit of a rally that we got yesterday. We look at the numbers here. We're looking at R1 is 99, so this would be a test of the 6,000. I suspect if we get there, they're going to trade it up and try to test that 08 level. Probably the most likely, we probably have better, well, right now 65% probability that we'll get to 60-21, 85% we get to this 99 level. We're trading 83 right now, and then on the downside, 59.60 is 90%, 38's about as low as it's going to get. We did able, like I said, we didn't quite get down to the 5,900 even yesterday. So let's take a look at the trades. Breakout long. So it says it breaks over 60, target 21.83. Where's the stop? Stop at 59.80. So risking, kind of interesting trade. Risking 20 to make 20, 1-to-1 risk. I don't like that so much, but I was able, like I told you last night, to do the 59.25 and trade it down to, I think I covered at 12, just the way everything was looking. But these breakout trades are always hard. And then the other one is current entry is they're suggesting you buy now. Target 60.43, which would be heading up to that. Let's just bring that number up. I didn't realize I was probably in the way there. Hang on. Let me put those up for a second here. Yeah, so here's that first trade right here. Then the ride to R3, 59.85. There's another momentum long trade here. But I think what we're looking at here is probably 21 is probably likely to get hit. 43, I think they're going to try to run this thing tomorrow. It makes sense. But I would watch these trigger points, and then the support 59.60, 59.38. So 59.60's got 85% probability to hold. And then, 75 probability on the R1, the 21 trade. All right. Yeah, sorry about that. I just put that trade on at 83.25. We'll see how that plays out. Okay. All right, so let's go and do Bitcoin. We'll call it quits. That'll put us probably right at the hour. I thought we might get done a little early, but so much for that. With just a few minutes. So let's go ahead and let's go over to the be kind of interesting to keep this monthly chart up here. Yeah, this is very interesting. See if I can. I've talked to you folks over the last couple of weeks. I've talked a fair amount about these what I call volatility bubbles. We usually have to normalize before we can uh, start to move up. Well, we have a big bubble here going on a monthly. There still looks like there's some time to consolidate. So there could be, let me draw this in. Yeah, there's probably a good chance. Good chance for the market grid to start to kind of come in into this kind of range, somewhat like what we did over here. We actually came out of this in a downtrend. This little volatility bubble here, we got into, we got a nice reversal. That was actually a pretty easy call. Now we're setting up this another bubble, and my expectation would be that we would see the markets start continue to trade. We still make a new high. I'll see if I can see these numbers. Yeah, this is right up here is the 120 level, right up here. So we could still see 120 on Bitcoin, but we should see some sort of range. And the unfortunate part of this is that we're going to have to work through this configuration before we're ready to go higher. We actually traded right up into the extremes here. So let me blow this out. Yeah, so I don't have enough data here to get the algos to work on this data. So let's go down to a weekly, which will give us a little bit better viewpoint. Weekly is projecting out flat. We actually have a downward slope in the pattern here from the standpoint of the market grid. And we're seeing, and this is something I've been talking about for days now, we about the end of the second or third week of June, we're going to come into a critical level where we're going to start to see the potential for a substantial amount of momentum loss and some risk. And I still feel very strong here that we have a few more weeks of potential strength, that we need to play this out. We need to hit that 120, 121 level. And then there's numbers at 130, 134, and then higher. We need to go there now. I think if we come too far back in this pattern, if we get back under the 100 level, then that would be a problem. I'm going to show you the daily chart here because I think this is a bit more of an issue. So we have we have a number of things going on here. We got live Fibonacci's, which are, I'll blow these up so you can see them on the screen over here. 97, 870, 92, we'll call it 500, 89, 150. These are numbers that are in play right now, and that also puts us back to retesting the 200-day moving average. If that happens, I think that's a really, really bad sign that we could end up in a longer, elongated, I wouldn't call it a bear market, but a more of a corrective pattern and falling back into all the work that was done on the weekly chart. Let me bring that back up. Yeah, so we went through this sideways move, came all the way down into 75, 76,000. Now we've rallied, made a new high. We need to roll here. Okay, I'm just telling you. If we fall back too much in this pattern, we're now going to get into a potential distribution top, and you could be looking at a year and a half before we're going to be positioned again. Maybe I'm exaggerating a little bit, but we're going to look at 6-8 months before Bitcoin's going to be in a place to run again. I'm not all that happy with having. I don't think having sovereign governments, the U.S. and other people playing in this market. I think there's a potential bad thing that could come out of having governments involved in Bitcoin. I just don't think it's a good idea. I know the stable coin and all that stuff that is being proposed, but I just uh, maybe it's the way it goes. My old buddy Hugh Hendry is screaming that currency is gone. It's done forever. Um, it was 2 or 3 years ago he was screaming that Bitcoin was a joke. So I'm not sure, but the bottom line is we are going to see some transition. Is it good to have these guys in here? I don't think so. I don't like it. But anyway, that's we'll kind of end it there. Let me just see if you folks have got any things that have been coming up. Yeah, so Mike is asking about the order book. Order book's in really good shape. We've not seen any liquidity issues. Yeah, so Damien, yeah, so you can go back on the YouTube channel and see that. If you go to October, November of 22, I was screaming. We were buying everything that we could find there. So there's information there you could find. Uh, Todd's asking, will we get a Fed intervention if the 10-year goes over 5? I don't know what they do. So probably not. Um, yeah, so it's interesting, David Ford. Why do we have so many small banks? Actually, that's what makes the U.S. banking system really good, because the small banks actually facilitate a lot of the farmers and a lot of the smaller communities rather than having the big banks. And I suspect you might be in the UK if I remember right. So, yeah, there's a lot more incremental control of the banking system there, and the also the bankers know their customers rather than dealing with some big guys out of New York, commercial guys. There's a term here in the U.S. called the good old boy banks. They still exist to a point. Yeah, the problem I can't do. Somebody's asking about the spies spreadsheet in Substack. The reason why I cannot is I need a live market to be able to run the sheets. I can't run it on yesterday's close, and you need live markets, so that kind of blows that out. Um, I'm just looking at a couple more. Bear with me a second, folks. Oh, David Ford, Australia. Okay. Yeah, I recognize you. Yeah, so I mean that's why the banking system's set up like that. It's actually it's a good thing. Um, it's sort of like think of it like this: so if you only have a few people to make decisions, especially around banking institutions, um, you kind of make it more liquid if you have a lot of small players, especially like I said, people that know the bankers and the bankers that know the customers, which are the smaller businesses and things, and a mainstream U.S. So it really aggregates out much better, and it's pretty easy. There's a lot of junk banks. It used to be back in the day that every MD doctor wanted to be a banker. So all these good old boy banks in the community were owned by the bankers or by these medical doctors that would set up these banks. I know it back in the day, 2 or 3 old customers of mine that were doctor banker types, and so for those of you that might be a doctor or know a doctor, you already know they know everything. I've had several customers there. Anyway, so let's kind of call it here. I hope you found this interesting tonight. We were able to cover quite a bit of different scenarios that are out there, and we'll see how things go. But best for the micro is get the Substack. My hope is, whoever, I forget who was asking about the spy, is that this project gets done. The problem we're having is authenticating some of the data to pass it into Claude to the API to get it so it kicks out, because I want you to be able to get this data from TradingView, put it into this module that will calculate those sheets and spit out. You don't need them to be interactive. What you do need them is to be just to generate a PDF or a graphic of some sort. So we're close. I've got a guy working on it. We've been working on it for a couple of weeks. We got a prototype that's sort of kind of running, but not ready for mainstream at the moment. Anyway, folks, thanks again for watching. Appreciate it. Managed to squeak in an hour. I thought we'd get done a little easier, but we'll talk to you soon. Have a great evening.